The market has fallen over 10% from its peak, and my inbox notification is buzzing non-stop since Monday. Family, friends, my readers, subscribers, everyone is asking me the same question. Should I buy now, or should I wait, or should I just get out of the market? I can understand this feeling. Watching our portfolio go in deep red day after day is not a comfortable experience. I get it completely. But before you do anything, before you buy, before you sell, before you even open your trading app, I want you to just sit with me for the next few minutes, because what I am going to share today is not only about this particular stock market fall. I will share with you a framework, a way of thinking that can help dealing with every market correction you will face in your investing life. So let's start from the beginning. What is happening right now? As of this week, the Nifty 50 has officially entered what analysts call a technical correction zone. What that means simply is this: the index has fallen more than 10% from its recent peak. The Nifty hit a record high of 26,373 on January 2026, and since then it has touched the bottom of 23,740 levels. This is a fall of over 10% in just 2 months. Now for new investors, a 10% fall on index level may sound very scary, but let me tell you something, this is not unusual. For sure, a 10% correction does not happen every time, but it has happened many times in the past. September 16 to December 16, the market fell by minus 11%. August 18 to October 18, the market fell by 13%. January 20 to March 20, the market fell by minus 38%. That was the COVID crash. September 2024, January 2025, the market fell by minus 11.6%. Like this, there have been 7 instances in the last 10 years alone where the market has corrected by more than 10%. So we can say this in reference to the current times that the market is currently behaving exactly the same way it has always behaved. Corrections happen, they have always happened, and they will continue to happen in the future as well. But let us understand what is causing this particular fall, because understanding the cause will help us to judge how serious is the current market fall. There are 3 main causes. The first and most important trigger is crude oil prices. On 9th March 2026, the Brent crude crossed $110 per barrel. The price surge was driven by the escalating conflict between the US and Iran in the Middle East. India imports over 85% of all its crude oil requirements. So when global oil prices go up, it hits India from 3 directions at the same time. First, it increases our import bill, which eventually widens our current account deficit. Second, it pushes up inflation because high fuel prices affect everything: transport, manufacturing, food, everything. And third, it weakens our Indian rupee. Why? Because we need to spend more US dollars to buy the same amount of oil. This is what analysts call a 3-way blow, and it is genuinely difficult for the market to absorb. The second factor that is causing the fall is FIIs selling. Large foreign funds have been selling Indian stocks for quite some time now. In 2025 alone, foreign investors sold a net of over 1.66 lakh crore rupees worth of Indian equities. This is the highest annual FII outflow in India's history, and this selling momentum continued even in January 2026. In January 2026, FII pulled out about 35,000 crores in a single month. Why FIIs are selling? It's partly because global uncertainty is pushing investors towards safer assets like US treasury bonds, gold, etc. It is also partly because the US dollar is becoming stronger, which makes emerging markets like India less attractive. FIIs are also selling partly because there is a sentiment that Indian markets were trading at a relatively higher valuations. The third factor causing the market fall is weak reported profit profits by Indian companies. Over the last several quarters, India's corporate earning growth has been below expectations. GDP growth is also slowing down from 8.6% in the year before to around 6.2% now. The economy is still growing, but it is growing slower, and markets do not like slow growth, especially when they have already priced in faster growth for the economy. And on top of all this, there are added pressures of US trade tariffs, a weak rupee. Investors worldwide are simply choosing to stay away from risky assets like equity. So we can say that what we have right now is a combination of genuine global concerns. In a way, we can say that all of these concerns have been identified and are known to us. But the thing is, all these factors are now hitting us at the same time. This is the main problem. But we must also understand that there are explainable reasons for this market fall. And when something can be explained, the solution generally also comes out soon. It is a general rule. So what does it mean? It means there is no need to panic. But I want to go deeper into this thing called the panic in the market. Panic selling happens all the time. We know it. But let's try to understand that this time it is panic selling happening or the market is genuinely crashing, and should we worry about it or not? Let's understand this from a historical context. Is this panic or a real crash? This is where most stock investors can go wrong. When the market falls, it feels catastrophic always. It feels like something has permanently broken. But history tells us a very different story. Let me take you through what actually happened every single time there was a major market fall in the past. In 2004, between January and June, the Nifty fell by 29% after a surprise election result. Mr. Vajpayee's NDA lost election to the Congress. It felt like the end of the world for many NDA supporters. But within 14 months, the market had fully recovered and went on to see new highs. Similarly, in 2008, during the global financial crisis, the Nifty fell by 60%. This was a genuine, deep, painful crash. And even from these intense fall, the market eventually recovered. I remember the Sensex fell to 8,000 levels. But where is the Sensex now? It touched 85,000 levels in 2025. It's almost 10x from its 2009 levels. In 2015 and 2016, the market fell around 20% due to global commodity concerns about China's slowing down, and troubles in India's banking sector. But from this as well, the market recovery started happening within 1 year. In 2020, during COVID, the market fell nearly 38% in just a few weeks. Felt like the world was ending, but recovery happened within months. Do you see the pattern? Every single time the stock market has fallen, whether it was 10%, 20% or even 60%, it eventually recovered without exception. Research on the Nifty 50 going back to 1999 shows that if you held an equity fund for 7 years or more, the minimum return was always positive, and the average CAGR over long periods have been around 14% per annum in India. Now compare that with the 3 to 4% you get in savings account or 6 to 7% from fixed deposits, and you will understand why long-term equity investing is so powerful. So when people ask me, is this panic or a real crash? My honest answer is this: it does not matter as much as you think, because even in real crashes, patient long-term investors have always come out unharmed. The thing is, you must stay patient when the market is falling. The only people who permanently lost money were the ones who panicked and sold at the bottom. According to one study, after corrections of more than 10% in the Nifty 50, the average recovery time has been around 15 months. Some recoveries took 6 months, some took 3 years, but the direction was always the same, upward. And new investors must always remember this fact about the stock market. How do I invest in a falling market? Okay, so history is reassuring, but let me be practical now, because just say invested is easy to say but harder to do, right? You need a proper structure, a checklist to implement the idea of being patient and staying invested even during crashes. So here is how I personally invest when the market is falling. I ask 4 questions to myself and try answering it as honestly as possible. The first question I ask myself is this: is the economy fundamentally broken, or is this only a temporary shock? This is the most basic question that comes to my mind. If the economy has deep structural problems like a banking crisis, stubborn inflation, or corrupt governance, then the fall in the market can be justified. But if the fall is driven by temporary external factors like high oil prices, FII selling, or global uncertainty like a war, then the underlying long-term story may still be intact. Right now, India's GDP is growing at around 6 to 6.4%. This is lower than earlier estimates, but it is still one of the fastest growing major economies of the world. Why do I say so? The banking sector cleaned up its balance sheets. Gross NPAs have fallen from a peak of 11.2% in 2018 all the way down to 2.1% in 2025. The government is spending big on infrastructure, and this will push the GDP. And domestic consumption is slowly picking up. All of these are not signs of a fundamentally broken economy. So my first check on India's fundamentals gives me comfort. The economy is slowing down a bit, but it is not broken for sure. The second question I ask is, are valuations now reasonable, or it was better before? Let's understand this practically using a very simple real life example. When the market was at its peak in September 2024, Indian stocks were trading at very high valuations. The P ratio of the Nifty was at elevated levels. In October 2024, the P touched 23.7 levels. Now, after a 10% correction, valuations have come down. The P of Nifty is at 21 levels. Indian stocks are still not extremely cheap, but they are more reasonable than before for sure. Particularly in the banking sector, we are seeing some very attractive valuations. Large private banks are trading at reasonable price to book value multiples. HDFC Bank has PB multiple of 2.34. ICICI Bank has price to book ratio of 2.71. Axis Bank has price to book of 1.99. Kotak Bank has price to book ratio of 2.26. Generally, a PB ratio close to 2 in such large private sector banks is considered good. Some public sector banks as well are trading at a P ratios of 6 to 9 times their earnings, which is historically very low. This does not mean that these banks cannot go lower, but it does mean the margin of safety has improved for these banks, especially in private bank basket. The third question I ask is, what is my time horizon? This is personal and only you can answer it for yourself. If you need the money in the next 1 or 2 years, say to pay for your child's education or for the down payment of your new house, for these type of examples, the stock market is not the right place to keep your money in times like now. Corrections and crash can last for months or even years. You should not take the risk of parking your money in stock market if you need your money so soon. But if your time horizon is 3-5 years or more, then the current correction is not a threat. Instead, I will say it is an opportunity. How? Because you are buying at lower prices than you were buying 6 months ago, right? Equity bought in such times and then if held for next 5-7 years can fetch fantastic returns. The fourth question I ask is, do I have financial stability to stay invested? This is something we do not discuss enough before investing. Before you invest in stocks, whether it is correction or no correction phase, you must have certain things in place. First, your emergency fund should be ready. 6 months of expense kept in a fixed deposit or in a liquid fund. Next, you should have no high interest debt like credit card dues or even personal loans. Third, the money you are investing through SIPs, you must be sure that you will not not need this money for next 5-7 years at least. If any of these three conditions are not met, your priority should be to fix those first. Why? Because there is no point buying a stock at a correction if you may have to sell them in next 6 months. If all these conditions are met, good fundamentals, better valuation, long time horizon, and you also have a strong financial stability, then the answer to the question, should I buy, is definitely yes. But even then, do not invest all at once. Invest systematically and be patient all the time. Now let me briefly talk about where I personally think the better opportunities are in the current environment. I want to be careful here because I am not giving specific buy or sell recommendations. What I am sharing is a general observation of where value appears to be emerging after this correction. Idea number one. The first area is the banking sector. Indian banks have cleaned up their balance sheets remarkably over the last 5 years. The NPA situation, which was a serious problem back in 2017 and 2018, is now largely behind us. Credit growth is stabilizing. The RBI has already cut the repo rate to 5.25% in December 2025, which is good for credit demand. When borrowing becomes cheaper, more people and businesses take loan, which helps banks' profits. Large cap private banks and a few selected public sector banks are now trading at valuations that look reasonable compared to their historical averages. Idea number two. The second area worth watching is domestic consumption. These are those companies that serve the Indian consumer directly. Rural consumption is picking up. The rural volume growth hitting 7.7% in the second quarter of FY26. The government's income tax relief announced in the recent budget is also expected to put more money in the hands of the middle class. This should benefit FMCG companies, consumer durables, and related sectors. But this will not happen in quick time. Investors must be ready to hold quality FMCG stocks for at least next 3 years. I will say the longer will be the holding time, the better. This is my guess. Idea number three. The third area is defense and capital goods. These companies have massive order books that provide multi-year revenue visibility. Companies like HAL and BEL order book alone stands at approximately 1.89 lakh crore rupees. But this is also true that these stocks are not cheap. A public sector company trading at a PE of 30 and PE of 55 is not common. So personally, I may not invest in such defense PSUs, but it is also true that their revenue and profit visibility is very strong. Now, I am not saying to go and buy all of these tomorrow. What I am saying is, in a market correction, quality companies in good sectors become available at better prices. What I mean is that another 10% correction and the same stock may start looking like an opportunity. So let me conclude and give you my final thoughts. Remember why you started investing. It was not to get rich tomorrow. It was to build real wealth over time. The market will help you do that, but only if you have the patience to let it help you. A crashing market demands only two things from you: buy good stocks and then hold.